Welcome back to the deep dive. Now, I know 2026 taxes probably haven't been top of mind for most people just yet.
Not at all. It feels a long way off.
It does, but the Canada Revenue Agency, well, they've been busy. They've already released the mandatory figures that are going to define your next filing year.
And this is really information you need to get ahead of, especially if you're a salaried employee.
Exactly, or even more so if you're in that high earner category. There are some mandatory payroll changes here, some credit adjustments that will, you know, really shift your cash flow starting January 1st.
Absolutely.
So this deep dive is all about giving you the shortcuts, the analysis you need. Okay, let's unpack this. And I think the only place to start is with the indexation factor. That's what drives all these shifts.
It really is. That indexation factor, it sets the baseline for everything that follows. Every single year, tax brackets, benefit amounts, they all get adjusted for inflation.
And for 2026, the CRA's number is
2%. The inflation rate they're applying is 2%.
2%. Okay, and that's actually a step down from the 2.7% they used last year.
It is, which, suggests that the official measure of inflation is trending a little bit lower.
So what's most important for people to understand about that 2% figure?
I'd say it's the effective date. This indexation, it applies immediately, January 1st, 2026, for all the income tax brackets and the non-refundable credits.
Okay, so things like the basic personal amount.
Exactly. But, and this is the key distinction, if we're talking about income-tested benefits, say the Canada Child Benefit or the GST credit,
Right.
those adjustments only kick in on July 1st, 2026. That's when their program year starts. So you feel the tax bracket change instantly, but the benefit change is delayed.
Got it. So that 2% factor is applied to all 5 federal brackets, and it basically just pushes the income thresholds a little bit higher.
Precisely. It allows a bit of your income that might have been taxed at a higher rate last year to stay in a lower bracket this year. It's marginal relief, but it's across the board.
So let's lay out those new index thresholds for 2026, because this is where the planning really starts.
Okay, let's do it.
So the lowest tier, that's 15%. And for 2026, you pay that on income up to $58,523.
Then you move into the second tier. That's 20.5%, and it covers income from that $58,523 all the way up to $117,045.
Tier 3 is 26%. That kicks in on income from $117,045 up to $181,440. And this is where your tax bill really starts to pick up speed.
It is, and if you break that $181,440 threshold, you're now entering what the CRA considers the zone of high earners, and a lot of rules start treating your income differently.
So what's that fourth bracket?
That's 29%. It covers income from $181,440 up to $258,482. And then anything you earn above that top ceiling.
Above $258,482.
Right, that's all taxed at the highest federal rate of 33%.
And we should always remind people, these are just the federal rates. Your actual marginal rate is, of course, going to be a lot higher once you layer on your provincial taxes.
And they all have their own indexation factors, too.
Let's stick with the federal side for now. Let's talk about the basic personal amount, the BPA. I mean, this is so foundational. It's the amount you can earn federally without paying any tax at all.
Right. And for 2026, the BPA has been indexed up to $16,452. Now, this gives you a non-refundable tax credit, but here's an important point, a point of clarity.
Okay.
The value of that credit is not calculated using the lowest 15% bracket rate. It's actually set by legislation at a specific fixed rate. For 2026, that rate is 14%.
So even though my first chunk of income is taxed at 15%, the actual value of my BPA credit is 14% of that $16,452.
Exactly. So the credit itself is worth $2,303 for most taxpayers. It's a really crucial distinction to make.
A very important one.
It is. But now you mentioned high earners before, and this is where not everyone gets the full benefit of that $2,303 credit.
Here's where it gets really interesting, because the way this BPA phases out, it feels like it was designed specifically to hit that top tier.
That's because it was. That's right. The government introduced a clawback on the enhancement portion of the BPA a few years ago. And that reduction starts. It starts precisely when your net income goes over $181,440.
Wait a second. That number sounds familiar. That's the exact same threshold for the bottom of the 29% tax bracket we just talked about.
It is not a coincidence. That is the critical dividing line. The reduction to your BPA credit starts there, and it shrinks gradually until your income hits $258,482.
Which is the exact threshold for the top 33% bracket.
Exactly.
So if your income falls anywhere in that 29% tax bracket, your BPA credit is actively shrinking. And if you earn more than the $258,482, you lose the whole enhancement.
That's the end result. Taxpayers in that top bracket, they only get what we call the old index BPA. For 2026, that's $14,829. So they lose out on the whole enhanced portion.
So that $181,440 number is a kind of double whammy. It pushes up your marginal tax rate and it starts cutting the value of your credits.
It's a major inflection point in the tax system.
Okay, we've covered the credits, the non-refundable side that helps reduce the tax you owe. Let's switch gears to the mandatory payments, the things that hit your paycheck right away, starting with CPP.
It's a sharp transition, for sure. So the standard CPP contribution rate for 2026, that stays at 5.95% for both the employee and the employer.
And the income it applies to.
That's the YMPE, the year's maximum pensionable earnings. It's what some people call the first earnings ceiling, and it's going up to $74,600.
Okay.
So after you subtract the basic exemption, which is still $3,500, the maximum standard CPP contribution for an employee will be $4,230.45.
That feels like a pretty standard inflation-driven increase. But the real mandatory cash flow hit for high earners, that comes from what they call the second CPP contribution, right? The CPP2.
This is where the budget shock really happens for people. CPP2 introduces a second ceiling, the MPE, and it means high earners have to contribute extra on a specific band of their income.
To boost their future retirement benefits, that's the idea.
That's the intent.
So what's the income range we're talking about here, and what's the extra rate?
The second earnings ceiling for 2026 is set at $85,000. So the CPP2 contribution, it applies only to that gap in earnings between $74,600 and $85,000.
Okay, so on that slice of income, which is about $10,400.
Right. On that slice, the employee has to contribute an additional 4%.
An extra 4%. So for anyone earning $85,000 or more, what does that look like in practice?
If you earn $85,000 or more, you're maxing out both. You'll pay the maximum standard CPP, and then you'll also pay the maximum CPP2 contribution.
And what's that amount?
The maximum extra contribution is $416 a year, and this is a mandatory deduction. So it translates to about $34.67 less in your take-home pay every single month.
And that's non-negotiable, an immediate reduction in cash flow for everyone in that bracket.
That's it. It's a definite cut to net pay.
Okay, just briefly, what about the other mandatory deduction, employment insurance?
GI contributions are also ticking up a bit. The maximum insurable earnings for 2026 are $68,900. With the standard rate of 1.64%, the max contribution is now $1,123.07.
A smaller increase, but it's all part of the same equation.
Exactly.
All right, let's pivot to voluntary savings, because these limits become so important for the very same people facing these mandatory increases. I'm talking about RRSPs and TFSAs.
For the Registered Retirement Savings Plan, the RRSP, the dollar limit for 2026, is going up quite a bit. It's now $33,810.
Wow, that's a huge deduction ceiling.
It is.
And for those high earners being squeezed by a CPP2 and the BPA phase out, I mean, that limit is critical. They need that deduction to lower their taxable income.
Absolutely. The power to defer tax on over $33,000,
yeah,
it makes tax planning so much more valuable for people in those top brackets.
But just to be clear, your actual contribution room is still 18% of your 2025 earned income, just capped at that new limit.
That's right, up to that ceiling.
So if the RRSP limit is soaring, why does the TFSA limit feel so stuck? It's staying at $7,000 for 2026.
Right. This is a great piece of legislative trivia, actually. The TFSA limit is indexed, just like everything else. But the rule says the limit only increases when the indexed amount reaches the next $500 increment.
So even with a 2% indexation factor, it just wasn't enough to get it over the hump.
Exactly right. The actual indexed amount for 2026 is $7,185.
Ah, so close.
So close. Because it hasn't reached $7,500 yet, it stays capped at the previous increment, which is $7,000. But that 7185 number tells us we are highly likely to see a raise to 7,500 very soon, maybe 2027.
A key marker for future planning. Okay, one last threshold we should mention. Old age security.
Yes, the OAS repayment threshold, that's the income level where your benefits start getting clawed back, is now indexed to $95,323 for 2026.
All right, let's wrap this up by talking about the cost of waiting. The CRA prescribed interest rates for the first quarter of 2026.
The base rate is staying at 3%, but it's the differential built on top of that base rate that really matters.
Okay, so if the CRA owes you money, like a refund.
They pay you interest at the base rate plus 2 points. So they'll pay you 5%.
But if you owe the CRA money for tax debts, penalties, anything like that, the cost is much, much steeper.
Far steeper. The rate they charge you is a full 4 percentage points higher than the base. So the interest rate on tax debt is a steep 7% starting January 1st.
Wow, 7%.
That is a very high borrowing cost. I mean, compare that to other consumer debt. It's a huge incentive to get any outstanding tax liabilities settled right away.
I agree. So what does this all mean? Let's boil it down. What are the mandatory adjustments you really need to plan for?
I'd say there are three main takeaways.
Okay, what's the first?
First, the overall indexation is a pretty modest 2%. It's just the tax brackets up a little, which offers some small relief.
Second, that complex BPA phase-out. It's specifically targeting higher earners, anyone between about $181,000 and $258,000, and it's actively reducing the value of their main credit.
And third, and this is maybe the most important, there is a definite mandatory increase in contributions through CPP. Every salaried employee earning over 85 grand is getting hit with maximum standard CPP and maximum CPP2 payments.
Which means a predictable monthly cut in take-home pay.
No question.
So at the end of the day, the government has slightly raised the filing threshold for everybody, but mandatory contributions and credit reductions are really tightening the screws on top earners. It just makes smart use of deductions that much more important.
It does. And here's a final thought for you to consider as you wrap up 2025 and start planning for 2026. Given that extremely high cost of carrying debt with the CRA, that 7% interest rate, and recognizing that massive $33,810 deduction ceiling you have for RRSPs, how does that influence your priority list?
It's a great question.
For a high earner impacted by all these changes, the strategic challenge is immediate. Do you pay down any tax debt that's charging you 7% interest? Or do you prioritize maxing out that huge RRSP room to slash your taxable income, hoping to shield yourself from some of these clawbacks and payroll hits? It's the classic debt versus deduction calculation, but it's really amplified by these new 2026 figures.